Good afternoon. Today we're going to do bad debt expense, and we're going to use the balance sheet approach. Okay. So it's problem 4 if you're following in the book. They tell us to start off with that we have a balance of $462 in accounts receivable and a credit balance of $30 in our allowance for uncollectible accounts. So on the balance sheet, we would report a net realizable value of $432, the amount we expect to realize. In my T accounts, I've got $462 in accounts receivable and $30,000 in its contra account. Allowance for doubtful accounts, and the net realizable value is $432. So let's walk through the entries here. In this problem, they tell us we have credit sales of $1,008,000, and I left off a 0. There we go, $1,008,000. So I'm going to record that and post it to accounts receivable and sales. They tell us that we had some sales returns of $50,000, and so we have net credit sales of $1,750,000 after I post that to sales returns. And also that's a credit to accounts receivable. We collect from some of our customers, and the problem says we collect $1,830,000. And you can see the balance in my accounts receivables changing with these transactions. Okay. The problem also says that we write off some accounts. Some of our customers, we read that they went bankrupt and we don't think they're ever going to pay us, so we write off their accounts. Then it says one of the customers who we wrote off paid us $3,000. So we get a $3,000 check in the mail from somebody that we'd previously written off. One of these people that we'd previously written off. So what I'm going to do is I'm going to undo the write-off. Just going to reverse that entry and put that $3,000 back on the books. So there you see, there's that $3,000 put back on the accounts receivable, and it also reinstates the allowance. Then, just like any other cash receipt now, I'm going to debit cash and credit accounts receivable. $3,000. Now, the astute among you will see that the $3,000 debit and credit to accounts receivable offset each other. But I go ahead and I make this entry because it makes sense to me. I undo the writing off of the account, and then I receive cash just like always. You really just have to do the debit cash and credit allowance for uncollectible accounts. Now let's stop for a minute and make sure we understand that regardless of which approach we're taking, whether we're taking the balance sheet approach or the income statement approach, these entries will be the same. They're the same under either approach. Okay. Now we're going to take the balance sheet approach, and we're going to, the entry, in fact, the entry will be the same regardless of which approach we're taking, but the numbers will be different. So if I'm taking the balance sheet approach, what I'm really trying to do is calculate this number. What amount do I need in my allowance account? What balance do I need in my allowance account to get the correct net realizable value? So I'm estimating the net realizable value on the balance sheet when I use the balance sheet approach. So the problem gives me, it breaks down this $347,000 in accounts receivable by when they were sold. So it says, gosh, 225,000 of these accounts were sales from November and December. 69,400 were sales from October. 34,700 were September sales, and 17,350 were from prior to September, August or earlier. Now let's look at this top layer, this 225,000. Keep in mind, we probably had $600,000 or $700,000 worth of sales during November and December, but many of our customers have already paid us. So this is not total sales. These are the accounts that customers bought it in November and they haven't paid us yet, but many of those customers have paid. I hope you can see that why, as the accounts get older, the percent we expect to not collect gets larger. So of our current accounts, we expect almost all of them to pay. We expect 96 to pay and 4% not to pay. Of the accounts that go back to prior to September, we don't expect many of them to pay. We expect 60%, a little over half to pay, and 40% not to pay. And hopefully it makes sense to you why these percentages get larger. We don't have enough information to determine these percentages, so the book gives them to us. So now I multiply 4% times 225,000 and I get 9,022. I multiply 15% times 69,400 and I get 10,410. 25% of 34,700 and 40% of 17,350. And so I'm saying, guys, I need a balance in my allowance account of $35,047. Let's go up here. So the balance in my accounts receivable is 347. I'm going to put that in up here. And I'm saying that I need a balance of 35,047 in my allowance account. I'm saying my net realizable value is 311,953. That's my best guess of what I'm going to collect. I come over here and I say, guys, I've got a $2,000 debit balance. So I need to credit $2,000 and $35,000. So this needs to be $2,000 debit plus 35,047. I need to credit my allowance account 37,047 to get the balance up to where I want it, 35,047. And you'll notice now my net realizable value is 311,953. I'm hoping that helps explain, and I'll get back later today with the income statement approach. Thank you very much.